Let's move on to our next guest. Central bankers, of course, as you just heard Nate, they continue their forceful pushback, I would say, against market bets for interest rate cuts. That's weighing on risk assets today. So what's an investor to do? Joining us now, Robert Schein, Managing Director, Partner at Blanke Schein Wealth Management. How does an investor play this back and forth? Fed going to cut March, now it's later, fewer cuts maybe. How do you view all this?
Well, good morning, John and Molly. And I think if we go back a month ago when I was in the Bloomberg radio studios, I did say that, the markets were anticipating and asking for in 2024 a rate cut. In fact, obviously you saw equity markets, risk assets price that in super aggressively. We were in the camp of, as I said then, and I still believe that it's going to be higher for longer, and the Fed Reserve is going to have to walk that tightrope simply because if you look at the sort of trajectory of inflation through history, you get two humps of inflation, and the Fed can't pull down sort of the interest rate to reignite some of the inflationary pressures. They have to ensure that inflation is anchored before they go ahead. I mean, about 78% of the time, historically speaking, inflation comes in two waves. So, what the Fed basically has done now is that for 2024, it's not a no on rate hikes, it's a no for right now.
How much do you think of the disinflation we've seen that the Fed can really take credit for? This is something I've been wondering, and I feel like so much of it has just been like the supply side normalizing, from those big COVID disruptions and a lot of those supply chains getting back in order. Do you really think, though, Rob, that the Fed can take credit for a lot of what we've seen?
Yeah, I think we're in a territory, including the Fed, that no one has ever seen before. So, retail is working through that. Services are working through that. Federal Reserve, businesses are working through that. One thing's good is the supply chain got tighter and then it got sort of a lot more efficient, if you will. And I think a lot of businesses became a lot more efficient, even moving forward. So that's going to be leading to greater profitability for a lot of businesses that learned through COVID. But if you look at the shift in consumption, and two-thirds of the economy is consumption, it's basically the services sector that's still seeing that spike up. Look at airline prices. Look at all the inflationary prices where people are like shifting their spending. We just got retail sales, goods. American consumer will always find a way, whether it's the credit card or whether it's the savings that they had saved up to make certain that Christmas is still Christmas at home. But it's going to take some time to see. We're going to see a lot more pressure build on the consumer, but the shift in spending is quite clear. It's still services for this year.
Okay, we can definitely say there's something of a pivot, the degree to which you can argue about, and we're definitely headed toward that 2%, although with maybe fits and starts, so a disinflationary environment or outright deflation in some sectors. I ask this of all our equity guests. What does that mean for earnings, especially the top-line sales growth?
Earnings, if you look at, again, that's going to be at the forefront. We just had the two biggest points, year to date as it relates to the CPI information as well as job market. It's not exactly going in the right direction in terms of as much movement as the Fed needs to see. But the earnings is on the forefront. And corporations, if you look at tech 2 years ago, tech literally started laying off in anticipation of a recession. We're looking at banks right now. At the end of last year, they started laying off. So it's basically a rolling sector recession. Pick your company, but a lot of companies are basically being a lot more conservative. Now, that jobs number is basically not going in the direction that the Fed needs it as quickly as at least the markets would like it. So interest rates could come down quicker.
So a rolling sector recession, does that mean we're in an actual economic recession or heading toward one?
I don't know if that'll actually transpire. If you look at the last 2 years, different sectors have had recessions at different times. That's why I think this time is different from a quote unquote recession standpoint. I know we've been waiting for about a year and a half, holding our breath for the official data to come out. But if you look at the different sectors and the performance of the different sectors, outperformance in some and underperformance in others, I think sectors, that's where you have to sort of be tactical in your performance of your asset allocation as you look into the market for 2024. the sectors that perform the best on a relative basis, let's say technology, are still going to perform well this year, but relatively other sectors will sort of come back. Let's call it healthcare, energy. I think those are times to start looking at overweighting those sectors for 2024.
Okay, so I put all that into the blender, turn it on high. What do I come up with? Where am I going to put my money?
Again, the 60-40 sort of asset allocation is where we're at. We like about a 10% allocation within that 40 within alternative investments. But I really like energy for the first 6 months. I think obviously the geopolitical tensions that we're seeing, earnings growth in that sector alone is up 40% in the last 4 years. And then you also have buybacks. I mean, they're dividend rich right now. And so where they're going to basically have that free cash flow is how they're going to allocate that. And we believe there's a lot of value there, plus a lot of M&A activity that we saw is going to be accretive. So we like the energy sector moving forward. And then healthcare. Healthcare, again, just like energy, is going to present a lot of value. Plus dividends, you get paid while you wait.
So Robert, just in our last 30 seconds or so here, just have to confirm, you're coming to us from Palm Desert, California today, is that right? Okay. Tell me.
Is that a TV screen or your window in the background? Come on, be honest.
But if you look right through us, we've got basically a Palm Desert Chamber of Commerce, snow-capped mountains out here. It's 70 degrees, so come on out.
And also nearby is a beautiful tennis center, which I got to ask, are you going to be at Indian Wells in March?
We love the Indian Wells PNB tennis event. It's a first-class event. And it's international and it's growing every year. So it's a perfect time of year.
Yeah, that's big on my list for next year. This year, going to the Miami Open, though.
It always comes back to tennis for you.
It has to. We haven't even talked about the Australian Open yet. It's really just a huge oversight on our part. We will be getting that to you, everyone. Don't worry.
Bob, thanks a lot. Appreciate it. Robert Schein, Managing Director and Partner at Blanke Schein Wealth Management. Thanks for putting up with us.